Wow. The chart that rules them all is plunging down again. Look at where we are. We're basically at the low that we made at the very beginning of 2019. And I think this is the most important chart out there. And this is what's causing the market to peak out. Hey, everybody, Courtney Smith here. Great to have you here. Great to read this. Always so exciting. But let's get right into the market. So the market started to dip here. 5 days in a row down, although a couple of those days were no big deal. But nonetheless, down. I put on there a retracement zone, and I'm looking for the market to dip down into that level. Now, the thing that bothers me is the chart that I just showed you. We'll get into it in a little bit more detail when we get down to our yield curve chart, but look at what happened there. We're seeing that the market is starting to crack under the pressure of the yield curve. The yield curve is a precursor to the future. It predicts the market and the economy 1 year in advance. Notice on that chart that the previous low was at the beginning of this year. Notice that the low on the market was a week before that. Notice that we plunged back down again over the last week, and notice that the market is under pressure. So that's the key chart that you need to be watching every single day, or at least once a week when you come to Wall Street Winners. So look for the market to retrace down into this retracement zone. At this point, I don't think it's the beginning of a new bear market, but it all makes me nervous. The Dow Jones, another big change here. If you look at the little box in the upper right-hand corner, there's a couple of things that happen. First of all, the red line went above the green line. The red line shows selling pressure, and it's now greater than buying pressure, which is the green line. So that's the first time we've seen that in a couple of months. So that's a significant change. Also, the black line in the little box is the ADX, and it says, well, that the bull market, it's kind of over. Now, it's not saying we're going into a bear market. It's just simply saying the bull market's over. We're really into a neutral market at this point. But still, I want it to be telling me. I want it to be going up, telling me that there's a bull market. Nope, it's not telling me that anymore. In other words, as we go through our presentation here this morning, you're going to see a lot of the supports being kicked out from the bull market. Not saying a bear market, but not saying a bull market anymore either. Here's the Nasdaq. Look at the plunge-o-rama in the purple predictor. It had been a major bullish feature in this market, but as the market has come down, the purple predictor is coming down even more, which shows that as the market ran out of gas a week ago, the smart money decided, you know what? Just like what I've been telling you for the last several weeks, the lack of upside momentum is bearish. So we need to be getting out of this market right now and take our profits. And that's exactly what the smart money's doing. And of course, you're watching this because, of course, you're part of the smart money too. Okay, seasonality, another one. We got right up to the breakout point, that yellow line, 158. One day it broke above it, and now we're back below. So never did shift to bullish. Never did shift to bullish. We're back to neutral. You see how so many of these indicators are neutral? Seasonality, however, is bullish, but it's not working. The yield curve, we're down at the lows. And this is, as I say, it may be a red flashing light. It's definitely a bright yellow. Definitely a bright yellow. So let's be clear. This is a bad situation that we're looking at. Now, it doesn't say that the market is going to plunge now. It says the market will plunge in a year. But we got down to this level at the beginning of January. We're back there again. So really, I would use the beginning of January as the trigger point. Now, this indicator, I say it's a 1 year leading indicator, but that's give or take a couple of months. That's give or take a couple of months. All right, asset allocation. They bailed out of the stock market. They hunkered down into the bond market. Risk indicator, down a little bit, not much. The risk indicator is very important because it tells us how much risk the market wants to take. And at this point, it's still pretty good, but once again, not a lot of upside momentum. So it looks to me like they're going to start hunkering down here as well. Our global shares basically following the U.S. Bonds up. Why? I already showed you why. The asset allocation. They sold stocks. They bought bonds. Bonds are going up. Now, this is actually bad news because this is why the yield curve is going flat. The Fed has hiked interest rates up to a certain level, 2 and change. They haven't moved. So the short-term interest rates are staying exactly the same, but over the last week, we saw long-term interest rates go down. Why? Because bonds went up. So when bonds go up, interest rates go down, and that's causing the flattening in the yield curve. Bond key factors. The bond yields is the green line. The blue line is 10-year treasuries in Germany, and that's our biggest competition. That's the most powerful indicator short term. But the other two indicators are the gold line, which is gold, and the chart itself, which is commodity prices. They're both starting to go up. Now, those are leading indicators of bond yield, so they can lead from 3 to 6 months down the road. So what this is all suggesting, when you put it all together, is long-term interest rates are going to go down near term, but go back up again in about 3 months. The dollar broke to the upside, then it retraced on Friday. Still looks like a pretty good breakout, but I'm not that excited in trading it. Gold cracked down. Now, what should happen is on the far right-hand side. We should see a rally up towards the uptrend line and then a resumption of the down move. So this whole bull market, it's over now. You don't need to be in gold anymore. You can get out. So we got a nice run out of this, but it's over. Gold key indicators, interesting again. The top one is bearish. The one in the middle is pretty neutral. And the one down at the bottom is bullish over the last week, but bearish since the beginning of the year. So no big reason to be in gold right now from these indicators. Fully paid up members, you know what I'm going to show you later. Crude oil, what I've been telling you, it's just run out of gas. So the fundamentals say this should go up to about $68. If this is a true head and shoulders bottom, we should get up to $68, $70. But look at this market. We haven't made a new high in 3 weeks. That's not the definition of a bull market. Now, it could be a consolidation pattern, and if we broke above 58, I'd want to be getting long again. But right now, dribbling sideways, better to keep our powder dry and wait for better opportunities. Now, as you know, I've been getting more and more bullish on Bitcoin. Here you can see the purple predictor breaking to new highs, showing that the smart money is taking advantage of these cheap Bitcoin prices. Technicals, still not that great, but if we break above 41.95, I'm going to want to get long Bitcoin. All right, freebies, you know we love having you here. Big kisses to you. If you don't have this, please get it. Very, very important for understanding what's going to happen in the coming year. Also, just check it out, man. I mean, you know, there's so much good stuff over at Stock Butler. All right, that's it for you freebies. Fully paid up members, hang in there for just 1 second. More interesting stuff.